Hello students, welcome back to this discussion of the chapter Adjusting the Accounts. So before this short video, we haven't discussed anything about adjusting. Why? Because before starting the adjusting or adjusting entries, which we will talk about just now, it's better if you understand some other related concept. So that's what we have done here. So in this video, we'll start our discussion on adjusting entries. So here in this video, we'll talk about the need for adjusting entries, why we are doing adjusting entries, or why it is actually needed or not. And we'll also talk very briefly the types of adjusting entries are there. Okay, in the following videos, we'll talk about them in detail, but in this video, we'll just get a good idea about what different types of adjusting entries we can expect in our accounting process. Okay. So with this, what is adjusting entries? Adjusting entries are basically a special type of journal. They are just journal. Journal means for any transaction, we have an equal amount of debit and equal amount of credit. Some accounts are debited, some accounts are credited from the same amount, right? So adjusting entries is also like that. It is a one type of journal, and this adjusting entry, which we'll just after this we'll learn about with example. So we'll see that these adjusting entries are needed to ensure that the revenue recognition we have talked about and the expense recognition we have talked about, they are actually being followed. So if you want to ensure that we are actually following the gap in terms of revenue recognition and expense recognition, so for us, adjusting entry or recording the adjusting entries is a must. Okay, so be very careful about that. Adjusting entries are needed because of if you want to fulfill or if you want to follow the revenue recognition and as well as the expense recognition principle. And these adjusting entries are important because our trial balance, in chapter 2 we learn about that. First we prepare the journal, then we prepare the ledger, and after that we consolidate all the balances of the ledger and prepare our trial balance. But this trial balance may not contain up-to-date and complete data. That's why a need for adjusting entry comes. How? I'll just explain very briefly here, and in the following videos I'll explain that thing in detail. Okay? So just think about, why does trial balance need to be updated? Because it's not updated, right? Why it is not updated? Just think about a particular example. You'll be very clear about that. This is the example. Suppose a business follows monthly accounting period. That means after every month they prepare their financial statements. They are following monthly accounting period. So, from your knowledge of the recording process chapter, where you have learned a journal for the first time, you can figure out this transaction. What will be the journal of this transaction? What is the transaction? On May 1, somebody has paid rent of Taka. Suppose you have paid rent of Taka, 12,000 in advance for total 12 months. So based on your or depending on your learning from chapter 2, I am sure that you can easily guess the journal for it. Which account should be debited? Is it an asset account or expense account? Exactly. Because we have just paid the rent in advance. Still we haven't received any service on May 1. So rather than terming it or rather than saying it, considering it as an expense, we have to record it as an asset. So prepaid rent, which is an asset, should be debited. And since we have paid cash of 12,000, cash another asset account which needs to be credited. Because asset account, when they are reduced, we credit them. Right? So this is the journal you have posted or you have written on May 1, or you should write at May 1. Okay? Now think about that. Is the journal is right or wrong? Exactly, it's right. You have the right amount of, you have the right logic behind that. Since you haven't used the service of the rent, you haven't used the rent service, you are right to consider it as an asset. But think about, today is May 31. That means 1 month has gone by when you paid for the rent, for the advance rent, right? Now think about that 1 month have gone by and 1 month you have used the service, the rent service. Is it? Yes. You have used the rent service for 1 month. Now tell me, if anybody asks you how much asset in terms of prepaid rent you have now on May 31, will your answer be 12,000? Exactly, no. Because now you have only future benefit left of 11 months, not the whole 12 months, because 1 month has gone by. But to answer that, if you follow your record strictly, you will find out that your record has a prepaid rent, which is an asset account, balance of 12,000. And that record is not right? Because you should have prepaid rent asset of only 11,000. So 1,000 should be decreased from that account. And that 1,000 should be called as your expense. So we have to do something about that, right? So this is why there should be a new journal or a different type of journal. We call it adjusting entries, so that these accounts, so we have the prepaid rent account and rent expense account, they have the right balance at a particular point of time. Okay, and in the following videos, when we will discuss each type of adjusting entry, we will discuss them in detail. Okay, so from this video, just think about that adjusting entry is important, because without adjusting entry, you cannot get the right balance of each account because of the nature of the transactions. Okay, good. So you know that your trial balance do not show the right balance of every account. So in order to make it right, you have to make adjusting entries before preparing financial statements. If you prepare without making adjusting entries, your financial statements, that financial statements will give you a wrong data or wrong information. So we cannot do that. So before preparing financial statements, we have to make sure that all our accounts show their right balance, true balance, right? And in order to do that, we have to make adjusting entries. Okay? And one thing that's very important, you'll see when we will talk about the examples of adjusting entries, you'll see that whenever or what type of adjusting entry there will be always one account in the adjusting entry which will be related to revenue or expense. And we call these accounts as income statement account. And there will be another one that will be related to asset liability or balance sheet account. And that will be true for every type of adjusting entries. So if you prepare adjusting entries and you find out that both of the two accounts are revenue account or expense account, you are doing something wrong. One account should be from revenue or expense, and another account of your adjusting entry must be from asset or liability account. So you have to remember that if you don't want to make mistake. Okay, we'll see, no worry. So in the last slide of this short video, we'll just give you a brief idea, or I'll just give you a brief idea about different types of adjusting entries. There are some type of adjusting entries that are needed, which call it deferrals. Deferrals means the service providing or receiving service, they take place after cash is paid. So cash payment or cash received is made first and then the service comes after that. They are known as deferrals. And there are another type of transaction who are known as accruals. That means the benefit, we receive benefit or we provide benefit to other people, but we do not pay cash. The cash payment or cash received happen in the future. These are known as accrual. In the deferral, we have prepaid expenses. Prepaid expenses means whenever you pay for some expenses in advance. That means you didn't receive the service yet, but you pay it in advance so that you can receive service in the future. So that prepaid expense, whenever you pay them, you cannot call them as your expense. Rather, in the journal, you record them as your asset. So you debit prepaid expenses, right? Okay. Another type of deferral we call unearned revenue. Sometime you may take money, your business may take money before providing any service. At that time you are getting money, so that's a transaction. But at that time, since you are not providing the service yet, you cannot call it as a revenue. Rather than you should call it a liability. And this liability is known as unearned revenue. And in the accrual side, we have accrued revenues. Accrued revenues means something for which you have performed a service, but you haven't still got the money yet. You'll get the money in the future, or you're expecting to get the money in the future. They are known as accrued revenue. And the opposite of that is accrued expense. That means you have received the services from other people or other party, but you haven't provided them or you haven't made the payment to them. You'll pay the cash in the future. That's called accrued expense. In Bangla, we have a very easy term for accrued, and that's known as bokia. Whenever we say amar salary bokia, something like that, we mean that we have provided the service, but we haven't got the money yet. So they are known as accruals. In Bangla, bokia. Right? So with this, we conclude our discussion from this short video. Thank you for your patience. Hope to see you again, inshallah.